there really are two questions, and I'm actually going to focus on the first of these, which is the risk that climate poses to bank safety and to the financial system more broadly. There is a second set question, which is equally or more important, which is whether financial forces can be harnessed to tackle climate change. So like I said, here I'm going to be focused on the risk that climate poses to the financial system, and I'm deliberately going to not discuss the other question very much. But one thing that I do want people to take away from today's talk is that taking action to correct global warming does not in any way, shape, or form depend on financial vulnerability. So what I mean by this is that, there's an open question about how robust the financial system is to climate change. And I'll be going through some of the evidence on that question today. But in a sense, the answer to that question doesn't really matter, because we know that there are substantial impacts on humanity that are caused by climate change. And I would argue that the impetus, the need for us to act on climate change has already been established. If it turns out that the financial system is actually surprisingly robust to climate change, then that's fantastic. And that will actually give us increased scope to take some corrective actions. So if we're talking about the evidence related to climate change, we can point out that despite 50 years of global warming, or more than 50 years of global warming, a very well-established trend to higher temperatures in the atmosphere, and despite increased peril from global warming in the form of increased hurricanes, the fires in my home country of Australia, I could go through a litany of different examples. But despite this, what we find is that the evidence that past climate change has impacted the financial system is frankly underwhelming. The Economist put out an article that described the evidence for that global warming or climate change could bring down the financial system. They described that as underwhelming. The ECB released early results from their stress test, which is a parallel stress test in line with the CBES. And one point, so when they turned to corporate PDs, counterparty probabilities of default, which was the main focus of the stress test, they found that under a hothouse world scenario, so a no action scenario, that median PDs would rise by only 7%. Now, we need to bear in mind, of course, that in a tail portfolio that the ECB also analyzed, they found a more substantial rise for that tail portfolio, and they found a 30% rise, which is, to put it into context, it's like going from a 2% PD to a 2.6% PD. But if you think about something like the global financial crisis back in the late 2000s, what you find is that you can find mortgage portfolios where the probability of default rose by 2,000%. And that with the types of substantial shocks that were capable of bringing about large scale or widespread bank defaults, bank failures. And that's what most people would typically view as financial stability. So the interesting question in my mind is, why, despite half a century of climate change, do we still observe such modest changes in financial performance in terms of things like credit risk and so on and so forth? And that's really what I want to discuss and want to focus on today. So if we start by looking at this chart, what you'll see here is I've plotted two series here. One is global temperature anomalies, and I've aggregated these in a slightly unusual way, so they're quarterly averages. But nonetheless, you can see the trend there. I could obviously pull the curtain back on this series back almost a century, and it would demonstrate that the trend to higher temperatures has been unfolding for, at least the past 60 years. I've then plotted this against US commercial bank total delinquency rates, or C&I loans. And I'm using US data here just because it's convenient, because it has a very long history and everyone sort of is aware of the economic history of the US, and so the timing of recessions and so forth. So what you can see here in the blue series, so a couple of things to note here. The first is that the trending nature of climate is one of the most difficult things, aspects of this problem to model, because there are various other economic variables that have also trended over this period. So we could look at things like, interest rates, for instance, have trended lower since the mid-1980s. We could look at something like the male labor force participation rate, which has also, been trending lower over this period. And also something like, the third thing I pointed out was that the population has aged over this period as well. And so these are all long-term economic trends. And so what this means is that if we can find trending factors in, for example, credit risk data, then we still face an identification problem, in the sense that it will be very difficult for us to convince ourselves that climate is actually driving that trend behavior, as opposed to one of these other trending factors that are also present in the economy. Now, the way that you go about, comforting yourself that climate is actually driving the underlying trending factors is by looking at, or trying to find, natural experiments. So these are situations where one population is affected by a climate-related shock and another population, or an adjacent population, is unaffected. And there are many examples of these natural experiments. But the point here is that, it's very difficult to capture the trends and to be able to actually model them and project them into the future. One point to note here, of course, is that if anything, the credit data here is trending lower over time. And indeed, there's a correlation that's negative between these two variables. Now, I'm not going to fall for the spurious regression trap, but what this does suggest to us is that if there is a connection between climate and credit risk, then what this chart is telling us is that banks are adjusting their underwriting quality criteria dynamically over time in such a way as to keep the observed performance of the aggregate portfolio in line with this declining trend. And personally, I think the declining trend is due to improved technology in the form of data and analytics that help us to drive towards better underwriting decisions, broadly speaking. Now, the other point to note here is that if we overlay the 30% result from the ECB onto this chart, bear in mind the current delinquency rate for C&I loans in the US is about 1%. So a 30% rise involves going to 1.3%. And as you can see from this little diagram, that really is a drop in the bucket compared to some of the large swings we've seen in delinquency rates over the last 40 or 50 years. Okay, so that's obviously a top-down view. And so it's important that we dig deeper into this and try to understand. And like I said before, we're looking for natural experiments. And it's kind of like the intersection between very strong databases and the occurrence of natural weather events really comes through in hurricanes and using US data. So there's a couple of papers here. The first is the Moody's Analytics paper, which looks at C&I loans. this really corroborates the analysis of the ECB, and so it can be viewed in that context, and actually has very similar results. And this is a very impressive piece of empirical work that uses an insanely detailed analysis of perhaps the best database related to physical risk that exists at the moment. The other paper that's sort of a little bit counterintuitive is the one by Derugina, Kawano, and Levitt, although I'd encourage everyone to seek out all four of these papers and to give them a very close read. The interesting thing about Derugina is that they looked at they compared Hurricane Katrina victims to a control group, and they then looked at tax return information and were able to track the individuals as they moved away from New Orleans following the event. And bear in mind that the population of New Orleans dropped by a significant amount after the event. It turns out that the people who were most affected by Hurricane Katrina had a worse short-term income outcome, but in terms of the longer term performance, the Hurricane Katrina victims actually performed better in the long term than the control group. And the interesting thing about this is that it's kind of like the effect of the shock forced them to migrate. And then basically when they were making their decision about where to move to, they were basing that decision largely on economic opportunities. And it turns out that on average, they made good choices. So I think that's a very interesting question, interesting analysis, and something that really goes to the micro level relationships between climate risk and credit risk, and helps to put a lot of meat on the bones in terms of the detailed outcomes that we might expect from this type of analysis. But the other point to note here is that the results are mixed. So there are articles, there are empirical studies that show that there is a significant impact of climate on credit performance, but there are also others that show that the impact of climate is sort of mixed or muted or what have you. It goes the other way. And so it's important to sort of take an even-handed approach to these things and to look at both examples of empirical work that are out there. Now, I think the key question from my mind is to ask the question, why have financial results been so muted so far? And the first point to note, I think, is that if you go back to the chart from just a couple of charts ago with the credit losses that were sloping down, the interesting thing about that is that if you imagine that trend was instead reversed and you had increasing credit losses over time, the point about this is that shareholder discipline would kick in and shareholders would require managers to adjust their behavior, their performance, to ensure that credit losses remained low. And so if credit performance ever starts to trend higher, then shareholder discipline will come into play, and you will get a push towards an equilibrium rate of credit losses, and that will tend to keep credit losses in check. I should say that these are all theories and they're all testable, and so I would encourage these types of ideas to be tested to work out, in a sense, how robust, how likely it is that our luck will continue, and that credit losses will remain low as climate outcomes worsen through the horizon. The next set of, let's call them theories, relate to to the predictability of climate impacts. So we've got, physical consequences that were predicted very accurately by the previous generation of scientists. And then you've also got climate transitions that are more predictable than we've seen in other industries. And the general point here is that if climate impact is predictable, then the point is that investors, borrowers, and lenders can all make informed decisions on the basis of those projections, and those outcomes are less likely to go off the rails as a result. So, for example, I mean, you can go back to 1981 and a paper by Hansen. Hansen was and is still the leader of NASA's climate change research project. And you can see that the forecasts that were made in 1981 have been stunningly accurate over the subsequent 40 years. So the point is that investors and lenders who are making decisions on the basis of the best available climate-related physical forecasts would have had a very, very accurate set of forecasts in their back pocket. And therefore, things probably, they therefore had good outcomes. This is trying to explain why financial losses so far have been so muted. On the transition side, we can imagine that the transitions in other industries, like, for example, the impact of e-commerce on bricks and mortar retail, has been much more sort of fragmentary, difficult to predict, and as a result of that, you get a much more chaotic sort of impact and higher losses in areas that were impacted by things like the Amazon effect, as opposed to more sort of predictable climate-related transitions that relate to things like emissions reductions and moves to sort of reduce pollution and other policy imperatives like that. So the other set of theories that you can sort of imagine that you can posit relate to hedging strategies. So one is that financial risk tends to migrate. So areas that are more at risk of climate change, the economic activities in those places will tend to migrate to places that are less impacted by climate risk. And there are also situations where there are losers, but there are also people who are winners from climate change. And so in this situation, like, for example, if half the houses on a particular island get destroyed by climate, then the value of houses that survive that event tend to do better than baseline. As a result of this, it may be possible for investors and lenders to hedge their strategies and move their investments around and so on, and as a result, lessen the overall impact of climate change on financial outcomes. So there are many empirical questions that remain unasked and therefore unanswered, and we can only speculate about stronger relationships in the future. But what I would say is that it's very important that we remain vigilant and look for evidence that risk is, in some senses, under control. And the key to this will be early detection mechanisms. So in other words, though the risk has been muted in the past, if this starts to change and if risk starts to build, then it's important that we have systems in place that allow early detection of those changes in risk. And building these early detection systems will rely on very detailed data and very detailed analytical techniques. My concern is that the current stress tests overemphasize qualitative aspects, and that these provide low sources of information, low quality sources of information that cannot be invalidated or built upon. And finally, I'll end where I began, and just by saying that financial strength in the face of global warming allows the greatest scope for effective action to fix the problem that is generational and that imperils mankind.